Recently, Moody's, an international rating agency, downgraded the outlook of the Chinese government's credit rating to negative, a move that has significant implications for Beijing. Beijing is embarrassed and annoyed. We observe that there may well be unprecedented courage on the part of international investors, including Warren Buffett. The British media Financial Times reported on December 7th that two of Moody's employees revealed that the company had advised their Chinese employees to work from home and keep a low profile prior to the announcement. Non-executives in Beijing and Shanghai were advised that they shouldn't enter the office in the near future, and Hong Kong analysts were also advised to avoid traveling to the mainland for the time being. Clearly, Moody's has already anticipated the fierce reaction of the Chinese Communist Party, or CCP, and its corresponding suppression. I would like to stress that since the beginning of this year, China's macroeconomy has continued to recover and improve, and high-quality development has been steadily advancing. The new momentum of China's economic growth is working, and China has the ability to continue to deepen reform and address risks and challenges. Recently, a number of international institutions have raised their expectations for China's economic growth this year. They are optimistic about the strong momentum, resilience, and development potential of the Chinese economy. The International Monetary Fund and the Organization for Economic Cooperation and Development have raised China's economic growth expectations to 5.4% and 5.2% respectively for this year. Let's take a look at Moody's series of adjustments to China's credit rating prospects since December 5th. On December 5th, Moody's revised its outlook on China's sovereign credit rating from stable to negative. On December 6th, Moody's downgraded the outlooks of 8 Chinese banks, 18 mainland enterprises, plus Hong Kong and Macau credit ratings to negative. The 8 banks are China's 3 policy banks and 5 large state-owned commercial banks. Moody's said the downgrade was due to a change in the outlook on the Chinese government's credit rating from stable to negative. Moody's warned of deepening debt risks for local governments and a crisis in the real estate sector. In our view, the rating downgrade reflects the international market's perception of China and is relatively objective. China's state-owned banks are tied to the credit of the Chinese government. They are deeply tied to real estate, and roughly 40% of all financing is directly or indirectly related to real estate companies. When the real estate industry collapses, it will definitely affect the financial sector, banks, trust and asset management companies, and insurance companies. Their bad debts will surely rise dramatically in the future. These big banks are politically motivated. They will try to keep their non-performing asset ratios as low as possible by adjusting their statements, swapping assets, and using technical means to cover up the potential risks of these non-performing assets. But after the risk goes beyond a certain magnitude, the crisis will break out quickly and dramatically. Our channel has repeatedly shown the financial risks in China, and now Moody's ratings are also seeing it. On December 6, Moody's also downgraded the outlook of 18 mainland enterprises, including Alibaba and Tencent Holdings, to negative. The list includes 13 central enterprises and their subsidiaries, 2 local state-owned enterprises and their subsidiaries, and 3 private companies. They include China CNR, China Mobile, CNOOC, PetroChina, Sinopec, Dongfeng Motor, Alibaba, and Tencent. Alibaba, Tencent, Sinopec, PetroChina, CNOOC, China CNR, China Mobile, etc. are all blue chips. Blue chips, also known as high-performing stocks and weighted stocks, are generally stocks with a significant dominant position in the industry, active trading, high company visibility, and large market capitalization. After Moody's report came out, China's stock market took notice, with all 3 major A-share indices falling, and Hong Kong stocks also continued to extend their losses. On the same day, the China Blue Chip Index hit its lowest level in nearly 5 years. Hong Kong used to be an international financial center, gathering nearly 9,000 companies from China and overseas. On December 6, Moody's downgraded the outlook for Hong Kong and Macau from stable to negative. Moody's said the downgrade reflected its assessment of the close political, institutional, economic, and financial ties between Hong Kong and mainland China. The ratings agency affirmed Hong Kong's AA3 rating, reflecting the city's credit strength. But at the same time, Moody said it expects Hong Kong's political, institutional, and economic decision-making autonomy to continue to be progressively further eroded, following the implementation of the national security law in 2020 and changes to Hong Kong's electoral system. It can be imagined that this will lead to a negative impact on international financing, including the issuance of bonds by China, Hong Kong, and Macau, which will result in insufficient borrowing or higher interest rates, as well as an accelerated withdrawal of international capital from mainland China, Hong Kong, and Macau.
I think sentiment has been extremely fragile over the past 3 years. And we see investors reacting quite strongly to any negative headline. So you saw equity markets in particular correcting very strongly, both onshore and offshore, after the announcement of the outlook downgrade. So it is not going to help in terms of promoting investor sentiment.
This is a huge blow to the CCP. From November 28 to December 2, 2023, Xi Jinping visited Shanghai. It was seen as an attempt to show openness to the outside world. A report from Xinhua, the state news agency, said that Shanghai should implement the new development concept completely, accurately, and comprehensively, and accelerate the building of a modern socialist international metropolis with a world influence, and give full play to its leading role in promoting Chinese-style modernization and demonstrating leadership. In fact, the entire CCP has no idea how to carry out Chinese-style modernization. The party media has been repeating slogans and publicizing Xi Jinping's visit to Shanghai for several days, trying to build up the confidence of investors and entrepreneurs at home and abroad. At this juncture, it was poked and prodded by the international rating agency Moody's in one fell swoop. The series of downgrades negate some of the CCP's attempts to restore economic confidence, or rather, Moody's doesn't think the CCP can solve its current economic woes. One can imagine how furious the CCP is. The fundamentals of China's long-term economic growth have not and will not change, and we are confident and capable of achieving long-term and stable development. Moody's worry about China's economic growth prospects and fiscal sustainability is unnecessary. As friends from the business community have said, China has become synonymous with the best investment destination. The next China is still China, and we welcome business friends from all over the world to continue investing in China and deeply cultivate it. The CCP tries to use data to refute. China's two rating agencies, China Chengxin Credit Rating Group and Donggang Global Credit Rating, have come out to support the authorities. They declared that they would support China's sovereign credit rating, and the rating outlook was stable. This triggered Chinese netizens to uncover the special history of these two rating agencies. On May 7, 2015, the international rating agency Standard & Poor's lowered Evergrande's long-term corporate credit rating from BB- to B+ with a negative outlook. At the time, China's major media and the three main domestic rating agencies jumped into action. China Chengxin Credit Rating Group, Donggang Global Credit Rating, and United Ratings released credit rating reports for Evergrande Real Estate. Without exception, they all gave it the highest credit rating of AAA with a stable outlook. AAA means an extremely strong ability to repay debt, basically not affected by an adverse economic environment and extremely low default risk. Chinese netizens are speechless. In fact, in 2020, Chinese media reported, caught in the credit bond scandal, China Chengxin International and Donggang International were respectively being questioned by the authorities. The report wrote that the China Securities Association, CSA, was also concerned that certain individual rating agencies had upgraded the issuer's credit level at a rate significantly higher than the industry average. There were hidden risks such as inflated ratings, and the relevant rating agencies have been interviewed and talked to. Now, let's take a look at what's behind Moody's blows and see if it demonstrates a dramatic shift in certain aspects of the Wall Street bigwigs. On Moody's shareholder list are the names of more than 60 investment organizations, and those in the top 10 are big names, including Berkshire Hathaway at #1 position, which is stock investment legend Warren Buffett's company, as well as Vanguard Group, TCI Funds, BlackRock, Fidelity Funds, etc. Moody's is one of 5 growth stocks owned by Buffett, who currently owns 24.6 million shares worth $8.6 billion or 13%. We are speculating if it is Buffett who considers China so negatively that he has no qualms about going to war with the CCP. Wall Street is scattering its hands away from China, with Buffett having cut his holdings in BYD 13 times so far in 2022. Where is the stock legend betting now? Japan. He isn't buying any more Chinese companies. One might think that Buffett's investment in Moody's should be all about profitability and would not interfere with the company's ratings. Is this statement correct? Moody's is a professional rating agency, and it issued a downgrade warning for the US this year and also downgraded 8 small and medium-sized US banks. It won't make political moves or issue such reports specifically for the purpose of combating the CCP. There is no doubt that Moody's downgrades of China, Hong Kong, and Macau are based on professional judgment. However, unlike democratic governments, the CCP government has extensive global penetration. Its means of infiltration can be roughly summarized into 3 ways: blue, gold, and yellow. Blue means controlling and distorting information and data online. Gold means bribery with money. Yellow means blackmailing by means of creating and collecting scandals of important figures, including sex scandals. This network is huge and sophisticated. Therefore, a certain degree of courage is required to present facts and objectivity related to the Beijing government. Now, we see that the same major shareholders who invested in Moody's, like Warren Buffett, have actually also regarded China in a negative light. One of them, Wall Street giant Vanguard Group, is disbanding its last team in China. Bloomberg reported in March 2023 that Vanguard Group notified the Chinese government of its intention to close its branch in Shanghai. On December 7th, the Wall Street Journal published an article, "Wall Street puts a sell on its China holdings." The article reads, "The amount of money that institutional investors have in Chinese stocks and bonds has declined by more than $31 billion this year. Through October, the biggest net outflow since China joined the World Trade Organization in 2001, official Chinese data show." After the past decade, private equity funds targeting China have raised an average of nearly $100 billion each year. So far this year, they have raised a meager $4.35 billion, according to data firm Pre-Chin. A growing number of Wall Street executives are advising that investors should be more defensive in their exposure, placing their investments more heavily in Japan, India, and emerging market countries and regions other than China. Second, the CCP has repeatedly pressured financial institutions doing business in China not to disclose information unfavorable to China. In August 2023, Morgan Stanley, a leading Wall Street investment bank, was also censored by the CCP for downgrading its ratings of Chinese stocks. Therefore, Moody's must have considered this risk before releasing this report. As mentioned at the beginning of the episode, British media have reported that in order to avoid being raided by the CCP, Moody's advised its Chinese staff that it would be better for them to work from home before making the announcement of downgrading China's sovereign ratings. It even advised its Hong Kong-based analysts not to travel to China for the time being. A Moody's employee based in China even said that the company didn't offer an explanation when it asked them to work from home. But we all know why, and everyone is afraid of government raids. Chinese authorities have raided the offices of several US consulting firms this year and detained some of their local employees, which Beijing claimed was due to national security concerns. Imagine the possibility that Moody's executives as well as major shareholders, including Warren Buffett, are being privately approached and handled by the CCP. It won't be surprising if they were. As we have seen, Moody's went ahead and made its report anyway, with a series of heavy-handed blows to the CCP. A full-blown hit on China, Hong Kong, and Macau, major banks, and companies. It's fair to say that these companies and individuals must have withstood the pressure or possible threats from the CCP. So where is China's economy headed in the future? Currently, the party media is intensively promoting Xi's visit to Shanghai. It can be seen the CCP's efforts are centered on the economy, but it still hasn't forgotten about its red genes. Xinhua reports that Xi Jinping said, "Adhering to the party's leadership is an essential requirement for modernization of the Chinese style. Shanghai is the birthplace of the party, and we should make good use of red resources such as the site of the First Congress." On December 3, 2023, Xi visited a memorial hall for the CCP military in Jiangsu province on his way back to Beijing. He said that it was necessary to guide party members and cadres to carry on the tradition of not being afraid of difficulties, not being afraid of dangers, and being courageous in the struggle. At the Yangtze River Delta Symposium, Xi said that regional divisions and administrative barriers must be broken down on the basis of institutional mechanisms, that high-level opening up to the outside world must be promoted, and that the Yangtze River Delta should become a powerful engine for unclogging China's economic cycle and a strategic hub for connecting domestic and international double circuits. The CCP emphasized the inner circle before, but went back to the double circle later. It suggests that it seems to have run out of solutions. In reality, as long as the party continues to lead, reforms will be impossible. It'll always be the case that a layperson leads people with the know-how, and modernization would remain elusive. The red gene of the CCP is destined to be the gene of China's economy. It'll lead to an incurable tumor given circumstances. The Beijing government is now faced with internal and external difficulties, and the epidemic is making a comeback. In such an environment, it is feared that not many officials are willing to follow along and suffer. Officials and scholars who know about economics are suppressed, and many officials who have no idea how to carry out Chinese-style modernization are more likely to lie flat, doing nothing. In short, the red gene cannot prescribe a cure for China's economy.